Hello folks, part 2 here. We're going to talk about from chapter 10, the concept of gifted property, or what is our basis when we receive a gift from someone else. Now the general idea is it's usually the same as what the donor's basis is. It carries over. So whatever the giver's basis is becomes our basis. So example, Tom's basis is 2,000, Tom's brother's basis is also 2,000. This is what's called carryover basis. All right, and this works in almost every case except for when the fair value of the gifted property is less than what Tom's basis is at the time of the gift. So when Tom gives it away, the value of the property has dropped below what he paid for it. So if he had just sold it, he would recognize the loss. First and foremost, if you're a tax advisor and someone asks you about giving property, first thing you should always tell them is never give a property that has a value less than what you paid for it. Just go ahead and sell it and take the loss. But often they do not ask ahead of time, or you don't know, and so we have to know how to handle it when this happens. So if the fair market value is at below the adjusted basis, so here's fair market value, adjusted basis, this is what the donor, the giver paid for it, or they could have done any depreciation, whatever it happened, their adjusted basis here, okay? If the receiver is going to sell it for a loss, okay, then our basis is a fair value at the time of the gift, okay? So if we sell it down here, so the fair value was 10 and the donor's adjusted basis was 20, we sell for less than 10, then the fair value at the time of the transfer is the basis. If we sell it for over the amount of the donor's adjusted basis, then say in our case 20 over 20, then our basis is the carryover of donor's adjusted basis. Okay, so and then if it's any place in between, there's no gain or loss. So your basis is the same as what you sell it for. So when you receive a gift of a property, you don't know what the basis is if its fair value is lower than the basis of the giver until you actually go to sell it. Okay? Father gives stock to his son. The fair value at the time of the gift was 30,000. Dad had bought it for 70. So again, he should have just sold this and taken the loss, but he didn't. He gave it to his son. Okay. And the value is $30,000. It's less than that, so we won't know what the son's basis is until he sells it. If he sells it for less than 30, that's his basis is 30. If it's more than 70, his basis is 70. In between 30 and 70, his basis is the same as what he gets from the sale, so he does no gain or loss. Okay. Now, when the fair market value exceeds the donor's basis, the typical way, then you may have to include in your basis some of the gift tax. And you see there the percentage. Gift tax has become much less common because it doesn't really come into play until someone has given away $5 million again. So it's not as big a deal as it used to be, but it will never exceed the fair market value. So a gift is the son. Time of the gift it was 1,000. We had basis of 40. Now it's a little bit more normal. You give away property that has increase in value over time. I pay gift tax of 15,000. All right. So we're going to have the basis. Son's basis is going to be the carryover plus part of the gift tax. If it's after 1976, all of the gift tax before that. Okay. So this is how you see the amount of the gift tax that you include. Converted property is being converted from personal to business, okay? And so there's some special rules here because people would want to convert things to business property and then sell them because they can deduct the loss. Where if you sell your personal sailboat, you're not, and for a loss, you don't get it deducted. You have a sailing business, and suddenly you have a property that you could have a loss and deduct it on. And so, of course, people are creative to do that, so we have some rules to prevent that from being abused. Okay, so when you convert to business use, all right, any value that's declined gets ignored. Well, it can't be part of the loss. So basically, your basis in that converted property becomes the lower of the fair value or what you originally paid for it. Okay? So at conversion, if your fair value is greater than the adjusted basis, there's no unrealized loss, right? Because in fact, it's just an unrealized gain. So my basis in the converted property is going to start with the initial basis, add all capital additions, and minus all capital recoveries from the beginning, all right, included. So this is what I originally paid for it, plus any additions and recovery. Now, when you had it as a personal property, there was no depreciation. So there would have been no capital recovery for depreciation until it's converted to business property, because depreciation only counts for business property or rental property. It does not count on your personal house. There is no depreciation on that. If the fair value is higher than the adjusted basis, okay, again, all right, so let's look at an example. Converts a vacation home to rental property, purchased home for $80,000 prior to the conversion, had made some $10,000 of improvements, and it was valued at $95,000 when it was converted. So it looks like the value is higher than our adjusted basis. Our adjusted basis is $90,000, fair value is $95,000. Okay, so when we go to sell that, our basis is all so it would be the $90,000 would be his basis when it's actually sold later on. Okay, so he includes all of the additions previous to it, to conversion. All of those are counted as well because the fair market value is higher. If the fair value is lower, okay, now we've got a little bit of a problem. Okay, now it looks a lot like when we were given a gift, meaning we have kind of our gain basis and a loss basis. So the conversion loss basis is the adjusted basis that starts using fair value at the time of conversion. So if the fair value is lower than my adjusted basis, when you convert it, that becomes your basis for calculating depreciation and for calculating any loss when you sell it. Okay, so the date of conversion, all right, and then you only consider after conversion additions and recoveries. So it's like you started over with a new property at the fair value at the date of conversion. All right, that's only if the fair value is lower than the adjusted basis. And then from there on, you only consider the changes in value the changes in basis having to do with after conversion. So loss basis is started over, okay, and then we're only going to consider that from there on. Let's look at an example. Vacation home to a rental property, purchased home for $80,000. That's our basis. We made 10,000 improvements, so now our basis is 90, but the value is 76 as time is converted. So we're going to ignore the 90, and 76 becomes our basis going forward. Okay, and that loss basis is going to be used to calculate depreciation. And if we sell it for less than 76, then that's what we're going to use for our basis. If we sell it for more, the gain basis is going to be back up as if we had included all additions and all recoveries. So our loss basis is 76 minus any depreciation we take on it. Okay, our gain basis would be the 90,000. Okay, and then anything in between would be no gain or loss. Okay, so it works a lot like a gift. Sold it for less than 76. The loss is calculated using the 76. Above 90. Okay, the gain is the amount over 90, and then in between 76 and 90 would be no gain or loss. Stock splits, simple. They're not taxable. You get 2 shares for the price of 1. If your original basis was $10, you now have 2 shares of stock with a basis of $5 each, making it simple. Okay. Here's an example. Instead of $50, you now have a $25 basis per share. Stock dividends work very much the same way, as long as you are required to receive more stock and not cash. Okay. As soon as you're given the option of cash, then you've got income. But as long as you don't have that option, then it changes your basis. So your basis becomes lower in all of the shares. So in general, we recognize all realized gains, all right, but don't recognize losses unless they involve business or investment property. So you see a little bit of a unfairness there. All gains, kind of remember back to when we first started talking about what's included in income. Everything's included in income unless specifically excluded. Same thing here. Gains are included except where specifically excluded, and losses are only deductible if we have specific reason to, which is business and investment properties. Okay, so here are the things that we can actually have that are outside this general rule. So there are some casualty and theft losses. Well, it wouldn't be theft losses anymore, but casualty losses, but only in disaster areas now. So that's really gone away and become very minimal. Okay, some losses you cannot recognize no matter whether it's a business property or investment property, and certain gains have been specifically excluded in the tax law. Okay, so let's deal with the first one here, the wash sales. You bought stock, all right, and then you sold it at a loss, meaning you sold it for less than you paid for it, but you then turn around and buy it again. Okay, the same thing or substantially identical securities, and you've got a 60-day window, 30 days before and 30 days after the sale, that if you rebuy those shares, you cannot recognize the loss on that. So basically they're saying you didn't really get rid of the asset, so we're not going to let you take a loss on that. You're going to have to wait 30 days, or you're going to have to buy the new shares before the 30-day period starts. So, example, $8,000 for 1,000 shares of ABC common stock. You purchased additional 400. We sold them on May 1st. So there's not 30 days between April 4th and May 1st. So this sale is a wash sale, okay? Which at least to the tune of 400. So the loss on 400 shares would not be recognized because he bought that within the 60-day window. Okay? The other 600 is fine. So you have to look at how many. He gets to recognize the loss on the other 600 because there wasn't a wash sale for that. So realized loss, 2,400. 40% of it, or the ones for the 400 shares, is disallowed. Okay, so we only get to recognize the other 60%, or 1,440. All right, but that additional amount is added to our basis, is increased to the amount of the disallowed loss, so that when we sell it in the future, again, we'll be able to recognize that loss. So that disallowed loss kind of carries forward, if you will, to do that. Here's the calculation of your basis in those 400 shares, all right, going forward that you just bought. Remember, you rebought those, so now you're going to have to worry about when it's time for selling those. All right, we'll go into the other special situations in part 3.